The global energy market is undergoing a major shift as Europe moves away from U.S. natural gas supplies towards Canadian energy resources, affecting international trade and economic stability. This change represents a fundamental reorganization of energy alliances and market dynamics. The shift began during the conflict near Russia, when energy supplies to Europe faced disruption due to sanctions. The United States initially provided crucial liquefied natural gas, LNG, to help Europe through a difficult winter period. However, this temporary solution revealed problems. U.S. gas prices were higher than global rates, burdening European consumers and businesses. Washington's inconsistent policies created uncertainty about long-term supply reliability. Europe's view of the U.S. changed from a reliable partner to a strategic actor potentially using energy exports as a geopolitical tool. This, combined with high LNG costs, led European leaders to seek alternatives. Canada emerged as an attractive option with its abundant resources and stable political climate. Besides oil and gas, Canada offers critical minerals like lithium and cobalt for Europe's electric vehicle initiatives. Canada's consistent approach to international trade relations sets it apart. Unlike the U.S., Canada maintains steady, long-term partnerships with Europe. This reliability, along with commitment to environmental sustainability, aligns with Europe's green energy goals. Canada's advantages include political stability, transparent practices, and sustainable development focus. This shift represents a strategic realignment that could reshape global trade patterns. As Europe increasingly chooses Canadian resources, U.S. energy exports and economic influence face challenges. This transition indicates a restructuring of global energy alliances, with Canada becoming a key player in the international market. Breaking news: major shift in global energy alliances threatens U.S. economic dominance. European nations are increasingly turning to Canada for their energy needs, dealing a blow to U.S. economic interests. This shift in traditional energy partnerships is reshaping international energy markets. Canada's renewable energy sources, including solar, wind, and hydroelectric power, align with European Union's green energy targets, contrasting with the United States' reliance on fossil fuels. This makes Canada an attractive partner for European nations seeking sustainable solutions. Market analysts project this pivot could cost the United States billions in annual revenue, as Europe was previously the largest purchaser of U.S. liquefied natural gas. The implications threaten America's position as a global energy leader. The situation has escalated into a trade war between the United States and Canada, with both nations implementing retaliatory tariffs. This tension extends to critical minerals for electric vehicle battery production, where Canada holds an advantage. Canada's strategic pivot toward Asian markets, especially China, and the expansion of the Trans Mountain Pipeline, signals its intention to diversify export destinations, reducing dependence on U.S. markets. This shift carries geopolitical implications. The United States has used energy exports for diplomatic leverage with allies. As Europe secures a reliable alternative in Canada, America's influence could diminish. Experts suggest this realignment marks a historic shift in North American economic dynamics. As the U.S. struggles to maintain its position, Canada's emergence as a preferred partner for both Europe and Asia challenges traditional U.S. economic and diplomatic influence. The United States' dominant position in global energy markets faces a significant redistribution of power, with potential long-term implications for international trade relations and global economic stability. In a significant shift affecting global energy markets, Canada's strategic pivot to Asian energy partnerships is raising concerns about U.S. energy security and economic stability. Canada's increased oil exports to China, Japan, and South Korea signal a potential restructuring of North American energy dynamics. The stakes are high for American consumers and businesses. With the U.S. importing over 6 million barrels of oil daily, with 67% from Canada, any supply chain disruption could trigger economic problems. Industry experts warn that reduced Canadian oil exports would severely impact the American Midwest, where refineries are designed for Canadian heavy crude. This isn't just about gas prices, explains energy analyst Thomas Richardson. We're looking at potential increases across consumer goods, from transportation to food costs. The average American household could feel the impact within days. The situation resembles global energy disruptions during conflicts, but with potentially more severe consequences for the U.S. economy. American refineries cannot easily switch to processing different crude oil types without major modifications. While energy companies might benefit from increased domestic shale oil production, this isn't a quick solution. The transition requires massive infrastructure investment and faces environmental opposition. Global players are watching closely. Russia, OPEC nations, and China could use this situation to enhance their influence over international energy markets, especially as they seek to reshape global energy trade patterns. The U.S. administration must either de-escalate trade tensions with Canada or risk economic consequences. With winter approaching and energy demands increasing, finding a diplomatic solution is urgent. For American consumers, particularly in the Midwest, prepare for potential market volatility and higher energy costs. The broader implications for U.S.-Canada relations and global energy security remain uncertain. Breaking news: trade tensions escalate as Canada contemplates energy export restrictions. In a significant development that could reshape North American economic relations, Canada is considering drastic measures in response to ongoing U.S. tariffs, potentially including restrictions on vital energy exports. This move could trigger a surge in U.S. energy prices and create widespread economic instability. Canadian provinces are taking decisive action, with Quebec and Nova Scotia leading a boycott of American products. These provinces have removed U.S.-made alcoholic beverages from their store shelves, signaling a hardening stance against American trade policies. This is more than just symbolic resistance, says trade analyst James Morrison. We're witnessing the potential unraveling of decades of stable trade relations between these longtime allies. The ripple effects extend far beyond energy markets. Major U.S. manufacturers, including automotive giants General Motors and Ford, heavily depend on Canadian raw materials. Industry experts warn that escalating tensions could drive production costs to unsustainable levels. Tech sector leaders aren't immune. Companies like Apple and Tesla face potential component cost increases that could erode their competitive advantage. Smaller manufacturers might face possible shutdowns and layoffs if access to Canadian materials becomes more expensive. The U.S. faces several options: negotiating a new energy deal, increasing domestic production, or maintaining current policies. However, expanding domestic oil production presents environmental and regulatory challenges that could take years to overcome. The tourism industry, particularly in Florida, stands to lose billions if Canadian visitors reduce their travel south. With inflation already pressuring the U.S. economy, market analysts predict potential stock market volatility as investors grow wary of escalating trade tensions. As this situation develops, both nations face critical decisions that will shape North American economic cooperation for years to come. Stay tuned for updates on this evolving story. Breaking news: a seismic shift in North American economic relations threatens to destabilize decades of partnership between the United States and Canada, with potential losses reaching billions annually. Industry experts warn that Canadian tourists may significantly reduce their U.S. travel and spending, delivering a blow to American businesses, particularly in tourism and retail sectors. We're looking at a fundamental restructuring of North American energy dynamics, says Dr. James Morrison, senior economist at the Global Trade Institute. This isn't just about vacation dollars. It's about power and energy dominance. The conflict emerges as Canada strengthens its energy partnerships with European nations, who view Canadian resources as a more stable alternative to American supplies. This strategic pivot threatens America's position as a global energy supplier. As global markets experience volatility, the deterioration of U.S.-Canadian relations could trigger economic consequences. The traditional framework of cooperation is giving way to competition, especially in energy. Canadian Energy Minister Sarah Thompson states, "Our nation is pursuing a diversified energy strategy that aligns with climate goals while ensuring economic stability for our partners." U.S. officials express concern about losing access to crucial energy supplies. The State Department emphasized that maintaining stable energy trade relationships remains a top priority. Analysts point to broader implications for international trade patterns. The resolution of this conflict could establish new precedents for how developed nations navigate energy partnerships. The question now facing policymakers: can this relationship be salvaged before irreparable damage occurs to both economies? With billions in revenue at stake and markets watching closely, the next few weeks could prove decisive. Expert observers suggest this may represent a pivotal moment in international energy politics, potentially reshaping global trade alliances.